Welcome back. Well, we're in the peak of results season, so let's get straight to another IT major. We had Mphasis that came out with its set of numbers, and the street appears a little bit disappointed with what they reported. But to get a better sense of what's the outlook for FY22, we have Mr. Nitin Rakesh who joins us. Hi Nitin, thanks so much for joining in. Well, let's talk about growth first up. If I look at your numbers for the last year, your constant currency revenue growth was around 5% or thereabouts. That's despite the sharp 30% degrowth that we saw in the DXC business. What's the outlook for FY22? I'm asking you for a bit of a range. And also the DXC business, it's come down now to around 15% of total revenues. Where do you see this number stabilizing?
Sure. So I think, the good news is that we had 4 quarters of, successive 200 million plus TCV wins. That has given us, I would say, one of the best growth profiles in the industry in our direct business, which is now, in FY21, it finished at about 17.2% YOY constant currency growth. Of course, the reason we have a 5% number is the DXC number that you just gave out as well. We do believe that with the momentum we are seeing in deal wins and the direct business, we have a very strong visibility in growth for direct business at probably industry-leading growth numbers, which definitely exceeds the high teens number. I think we will settle the DXC number at somewhere around mid single digit as percentage of revenue, given that it was at 12% in Q4. So we do believe that direct business will actually grow further and will make up for some of the declines that we've seen, and we hopefully will actually have a well above industry growth even in FY22.
Right, we take that point, Nitin, direct business you said that is likely to grow faster. It was almost 17.2% in constant currency. You won an order, it's, there's a 51% jump in order wins. So what number are we looking at with regards to the direct international revenue growth going forward?
Yeah, I think I already said about high teens is the benchmark we can look at, purely based on the fact that I think industry-leading growth will probably require us to be at that level in the direct business.
Okay, all right, Nitin. So for the entity on the whole, given the fact that DXC, it appears it's going to continue to struggle, because I remember it used to be 25%, came down to around 15%. Last quarter it was around 12%. Now you're working single-digit number, so that's likely to struggle. So for the company on the whole, what kind of constant currency growth should we be looking at for FY22? And give us a margin band as well to work with, because a lot of the companies, a lot of your peers, they went ahead and they increased margins. But you guys, there's a bit of a compression out there. So what's the range we should work with for FY22?
Yeah, I think, again, we don't normally give a firm guidance range for the whole company revenue. We guide it on a relative basis. And I think on a relative basis, we definitely look like we'd probably be in the top quartile. Of course, we are still early in the financial year, but good visibility on direct gives us the confidence that we should see, good, strong growth at overall company level, well above industry average. On the margin, we've given a firm range of 15.5 to 17% EBIT. And I think, while a number of our peers have taken the one-time savings into their margins, they're also starting to see some pressure on the margins coming out of, the last couple of quarters of demand-supply mismatch. In our case, we've actually guided and we've stayed true to the guidance that we'll keep the margins in a tight band for FY21. We've delivered right in the middle of that band at 16.1%. But at the same time, we said we will accelerate the growth, and we've done that both in the overall business, especially in the direct business. And I think the testimony to that is the TCV wins we talked about, and even another large deal of $250 million that we announced for the current quarter that we are in the middle of right now. So I think from that perspective, we do believe that the margins do have an upward bias in our case, because we've held them stable, prioritized for growth, invested in bringing in new large deals, and then ramping them up. And that will definitely give us some operating leverage over the next 4 quarters.
Just to confirm, you said margins at 15.5 to 17%. That's upping the upward end of the guidance from 15.5 to 16.5?
Yes.
All right. And is there a chance that you can perhaps outdo that as well, or this is the band that you will aspire to maintain? Any more than that?
Right now the band itself is a little bit broader because, one, it's the beginning of the year. Two, given just the supply chain disruption that we've seen, we are carrying a little bit extra bench and capacity purely based on the fact that we want to make sure that we don't have disruption in both operations and growth. As we get through the current wave in India that you guys are just discussing about, we'll probably have a little bit better understanding of where the margins will land. So I think the band will tighten. But as I mentioned, I think the trajectory of the margin, medium term is definitely upward bias.
Okay, all right. Nitin, I have to give it to you all. The last 5 quarters, I think you've been delivering that $200 million plus. I remember it used to be around 150, 160 odd. So that's going pretty well. But give us a sense in terms of what is the average size of these TC wins?
I think the average size of large deals has actually gone up from about 27, 28 million 2 years ago to 79 million this quarter. So I think clearly we've taken that deal size, the average size of large deals up by 2.5x. The tenure has also gone up. They typically used to be in the 1 to 2 year band. Now we routinely do deals in the 3 to 5 year band. In fact, the deal we announced for current quarter, which is not in the numbers that we gave out for Q4 or FY21, that actually is a 10-year deal. That's the longest and the largest deal we've ever done, which basically shows you that there is a maturity of services, portfolio offerings, as well as delivery capability that clients are recognizing. And that's a great sign for us to actually start stitching even larger deals, especially as we look at multiple competencies coming together to deliver transformation services.
All right, take that point, Nitin. Thanks a lot for joining in and giving us all those details. So that's the management of Mphasis. The numbers were tad mixed, but the commentary rather positive, looking at high teen sort of growth coming in for their direct international business. Margins, the upper end of the margin guidance, upped by almost 50 basis points, and the deal wins look good as well. With that, what we'll do is take a short break, and on the other side, we'll keep an eye out on the markets and individual stocks. Stay tuned.